Welcome to the deep dive, where we try to cut through the noise and really get straight to the insights that matter. Today, we're plunging into a topic that, well, it's captivated countless individuals, a pursuit that, on the surface promises this incredible freedom and limitless financial potential: trading. Just picture it for a second, the idea of tapping into the market's endless flow of money, maybe turning fluctuations into personal prosperity, being your own boss, achieving true financial independence. It's an incredibly powerful dream, isn't it? Very seductive, draws in so many aspiring traders.
It really does. And that dream, it's so compelling, but it very often collides with a surprisingly harsh reality.
Right.
While the markets absolutely do offer this vast ocean of opportunities, there's a really significant and often, let's be honest, deeply frustrating gap. A chasm that separates simply understanding how the market operates from actually consistently turning that knowledge into reliable profits.
That gap.
Exactly. This gap is precisely what we're going to dissect today. It's the often overlooked yet absolutely critical psychological dimension of trading. It's really what makes trading one of the most challenging and, frankly, one of the most mysterious endeavors anyone can try to master.
That's the heart of it, yeah. So our mission in this deep dive is to map out how the focus in trading has, well, dramatically shifted over the past few decades. We're moving, it seems, from this singular obsession with just external market analysis, charts, economic data, all that stuff.
The traditional approach.
Right. To a really crucial internal journey, a journey of self-analysis, a deep dive into your own individual psychology. We'll try to expose the very specific challenges traders face, the common pitfalls that, ensnare even the brightest people, successful minds in other fields. And ultimately, we'll reveal what truly separates that small handful of consistent winners from basically everyone else, drawing on some truly fascinating insights we've looked at. Our goal for you today is simple: walk away with a much clearer, more nuanced understanding of what it actually takes to navigate the markets successfully. Not just intellectually, but well from the inside out. Okay, so to really understand why this internal shift is so vital, maybe let's take a little trip back in time. Explore how market analysis itself has evolved. Imagine you're back in, say, 1978. In the trading world then, there was a really dominant belief.
Oh, yeah.
Fundamental analysis was considered the only legitimate, the only proper way to make trading decisions. It was the establishment. Highly respected.
Gold standard, supposedly.
Yep, exactly. And technical analysis. That was largely dismissed, practiced by maybe a small eccentric fringe of traders. People often branded them as crazy or, at best operating on nothing more than mystical hocus pocus.
Hocus pocus, yeah. It's quite a contrast to how things are viewed now, isn't it?
Totally different world.
It truly is. And fundamental analysis, at its core, it aims for this comprehensive understanding of, well, of value. It meticulously looks at basically all the variables that could influence supply and demand for a particular instrument.
Like what kind of things?
Oh, everything. Macroeconomic stuff like interest rates, inflation, then microeconomic details, a company's balance sheet, earnings reports, or even things that seem tangential but can be impactful, like, say, global weather patterns if you're analyzing agricultural commodities.
Right. Complex stuff.
Very. An analyst would then build these complex mathematical models, painstakingly weighing the significance of each factor, trying to project what a price should be at some future point, all based on these logical inputs. It's a very rational, almost scientific approach to valuation.
Okay, but here's where the story gets really interesting for me, because this seemingly robust approach, it contained a glaring fundamental flaw, one that really led to its decline, didn't it?
Absolutely. It's fascinating. These elaborate fundamental models, with all their intricate calculations, they rarely, if ever, factored in other traders as variables.
Wait, really? They didn't consider the people actually doing the trading?
Largely no. Think about that. The models were built on objective economic principles, on what should logically happen based on the data. Yet market prices don't just move because of logical models. They move because people, real, living, breathing, often irrational people, express their beliefs, their expectations, their hopes.
And their fears.
Crucially, their fears and emotions, through buying and selling. The research we looked at points out that many floor traders, the very people who often have the power to swing prices, dramatically frequently had, and this is a quote, not the slightest concept of the underlying fundamental factors driving things long term.
Wow.
Their actions, moment to moment, were often triggered by purely emotional impulses, completely outside the neat, rational boxes of any fundamental model. Essentially, the people who actually move the markets don't always act rationally or, in an economically sensible way. Not even often, sometimes.
So that creates this massive disconnect, right, between the theory and the reality on the floor.
Precisely. And this disconnect between the logical prediction and the actual human behavior created what's aptly termed a reality gap. Fundamental analysis might meticulously establish what should be, what the price ought to be, if everyone acted perfectly logically and all the variables lined up just right. But the market, in reality, constantly reflects what is the current, often messy collective behavior of everyone involved, rational or not.
Okay, so even if the prediction was right eventually.
Exactly. Even if a fundamental prediction was eventually proven correct, the price movement in the meantime could be so incredibly volatile, so unpredictable, that it became, quote, very difficult, if not impossible, to stay in a trade long enough to actually realize that objective. Imagine being absolute certain a stock should go up based on fundamentals, only to watch it drop 30% first because of panic selling, before it finally turns around.
You'd get shaken out or run out of capital.
Exactly. This practical inconsistency, this inability to translate seemingly sound logical predictions into consistent, actionable profits, that's precisely what led to its widespread abandonment for practical day-to-day trading. It was, a beautiful theory perhaps, but it just didn't work reliably in the market trenches.
And that abandonment, that vacuum, it really catalyzed a dramatic shift, didn't it? Particularly from the late 1970s into the early 1980s. This is when technical analysis really started to gain widespread acceptance. It moved from the fringe right into the mainstream. And the reason, well, it sounds incredibly straightforward.
It was compellingly simple, really.
It consistently made money. Suddenly, it wasn't about some abstract hocus pocus anymore. It was about tangible, repeatable results that traders could actually see in their accounts.
That's the key. The core insight that technical analysts intuitively understood, and which, took the broader market community quite some time to fully grasp, is actually deceptively simple. While the market seems infinitely complex, with countless variables swirling around, the number of traders participating in it is finite.
Okay.
And a really significant observation is that many of these traders, across all sorts of time frames, they tend to repeat the same types of actions, driven by the same pursuit of profit, the same fears, the same herd instincts.
Ignorance emerge.
Exactly. These individual behaviors, when you aggregate them, when they're magnified by the crowd, they form collective behavior patterns. And the critical point here is that these patterns aren't random. They are observable and quantifiable, and crucially, they repeat themselves with a measurable statistical reliability.
So technical analysis is just organizing that.
Essentially, yes. It's a sophisticated method for organizing and interpreting this collective behavior into identifiable patterns, like chart formations, trends, momentum indicators. It provides a clear indication of when there is a greater probability of one thing happening over another, based purely on past behavior. In a profound sense, by studying these patterns, you're basically able to get into the mind of the market, anticipating what's likely to happen next based on historical precedents of human behavior under similar pressure.
Okay, so breaking that down, TA keeps the trader focused squarely on what the market is doing now in relation to what it has done in the past.
Right now, present tense.
It's not about what the market should be doing based on some external, logical, often disconnected model like FA tried to do. This laser-like focus on what is rather than what should be, that's what closes that reality gap, right? The one that plagued fundamental analysis.
Exactly. Instead of battling some theoretical ideal, you're engaging directly with the present reality of the market, as expressed by the participants.
That feels much more practical.
It is, and this shift in focus is truly transformative. Technical analysis not only effectively closes this reality gap, but it also, perhaps counterintuitively, makes available to the trader a virtually unlimited number of possibilities to take advantage of.
How so? Unlimited seems like a big word.
Well, think about it. Because these repeatable behavior patterns, these manifestations of collective human psychology, essentially they occur across every time frame, moment to moment, daily, weekly, yearly, and every time span in between. So technical analysis transforms the market from this bewildering, unpredictable beast into what feels like an endless stream of opportunities for those who learn to read its language. You're constantly seeing potential new entry points, new exit signals, new ways to capitalize on these recurring patterns of human interaction and psychology playing out on the charts.
Okay, this brings us to a really crucial question then. If technical analysis works so well, if it genuinely opens up this endless stream of opportunities and helps traders close that reality gap, Then why, especially in more recent years, are we seeing more and more traders shifting their focus again? Not towards even more complex market analysis, but inwards, towards this deep, often uncomfortable mental analysis of themselves, their own individual trading psychology. Why the turn inward?
And this is the question, isn't it? It likely resonates deeply with many people listening right now. The most probable reason you're even interested in the psychology of trading is likely a nagging, deep-seated dissatisfaction. You see the market as this entity of unlimited potential.
You can see the moves.
Exactly. You see the moves, you understand the patterns intellectually, you know the opportunities are theoretically there. But then there's this huge gap between that perceived potential and, well, what you end up with on the bottom line.
A P&L statement.
Right. Think about it. How many times have you looked at a price chart, clearly seen the market setting up for a big move, maybe it was an obvious breakout, a perfect reversal pattern, and you thought, yes, this is definitely going up, or it's
Yeah.
absolutely going to tank. You knew it, right? You had the analysis down pat.
Mm-hmm. Felt certain.
But then, what happened? You did nothing except watch the market move while you anguished over all the money you could have made. That feeling, that specific feeling of missed opportunity, of knowing but not acting, it's incredibly common, incredibly painful.
Yeah, that feeling definitely encapsulates the core issue, I think. There's this profound difference between predicting something will happen in the market, maybe on paper or in your head, and the intense, often intimidating reality of actually executing a trade. Putting your real money on the line, managing the flood of emotions that come up, making those precise entries and exits under pressure.
It's a whole different ballgame.
Totally. This difference, and others like it, that's what we're calling the psychological gap. And it's this gap that makes trading, as the source material says, one of the most difficult endeavors you could ever choose to pursue, and certainly one of the most mysterious to master. Yet, despite all this difficulty, the research we've explored makes a really powerful, unequivocal statement. It asks, can trading be mastered?
And the answer?
Not only is the answer an unequivocal yes, but that's also exactly what this knowledge is designed to help you achieve. That's a huge promise, isn't it? It speaks directly to the transformative power of really understanding this psychological dimension.
It absolutely does. And to highlight this profound difference between those who just, attempt to trade and those few who consistently succeed, consider a powerful analogy used in the source. Think about the Earth and the Moon. They're both celestial bodies, right? Orbiting in the same solar system. So on a very basic level, they share something in common.
Okay.
But fundamentally, they are as different in nature and characteristics as night and day. The Moon is barren, airless, stark. Earth is vibrant, teeming with life, dynamic. In a similar way, anyone can place a trade and technically call themselves a trader. But when you compare the defining characteristics of the handful of consistent winners with the vast majority of other traders, you find that they too are worlds apart in their approach, their mindset, their very nature as traders.
That's a great way to frame it. So if going to the moon represents consistent success as a trader, then yes, it's absolutely possible. A select few have proven it. But the journey itself is extremely difficult, and only a very, very small number of individuals have actually made it there, metaphorically speaking.
Right.
For most of us, looking at the market, consistent success often seems so close that we could just reach out and touch it. The money is constantly flowing, opportunities seem abundant, almost within grasp. Yet, time and time again, for reasons that feel baffling, that success just slips away or evaporates before their eyes, like a mirage.
Exactly like a mirage. And for those who haven't yet managed to cross this threshold of consistency, the only thing about trading that is consistent for them is, unfortunately, emotional pain. Sure, they might experience fleeting moments of elation after a random winning trade, but the overwhelming majority of their time is spent in this debilitating state of fear, anger, frustration, anxiety, disappointment,
Regret.
betrayal even, feeling betrayed by the market, and crushing regret. This isn't just about the financial losses, which can be significant, obviously. It's the profound, relentless emotional toll that persistent inconsistency takes. It just chips away at your confidence, your self-worth.
So, this naturally leads us to challenge some very common assumptions we might have about successful traders. What really differentiates these two vastly different groups? Is it just raw intelligence? Are the consistent winners simply smarter? Do they work harder, pouring more hours into analysis?
Grind harder.
Yeah. Are they just better analysts, maybe? Or perhaps they have access to some secret superior trading systems that the rest of us don't know about. Or is it something inherent? Maybe some genetic personality characteristic that makes them uniquely suited for the intense pressures of trading.
Well, the research we've looked at directly and powerfully debunks these very common myths. It actually reveals that most of the trading industry's failures are also some of society's brightest and most accomplished people.
Really? That's surprising.
It is. The largest group of consistent losers, surprisingly, often includes highly intelligent, successful professionals from other demanding fields. People like doctors, lawyers, engineers, scientists, CEOs of successful companies, wealthy retirees, seasoned entrepreneurs.
The people you'd expect to succeed.
Exactly. People who excel in environments that demand logic, discipline, strategic thinking. Furthermore, and this is truly striking, most of the industry's best market analysts are the worst traders imaginable. They can predict the market's movements with incredible accuracy, maybe write brilliant newsletters, yet they fail miserably when it comes to actually putting their own money on the line and executing trades themselves.
Wow, so analysis isn't the key.
It clearly demonstrates that while intelligence and sharp market analysis can certainly contribute to potential success, they are unequivocally not the defining factors that truly separate the consistent winners from everyone else. Something else is going on.
Okay, so if it isn't intelligence or sheer hard work or even superior analysis, then what is the defining factor? What's the secret sauce, so to speak?
Well, the core truth, according to this material, turns out to be remarkably simple, yet deeply impactful. The best traders simply think differently from the rest.
Think differently. How?
It's not about being inherently smarter or having some secret algorithm or privileged information. It's about a fundamentally distinct way of processing market information, perceiving uncertain conditions, and operating within that highly volatile, unpredictable environment. It's fundamentally a mental game.
Okay.
Precisely. The defining characteristic that truly sets consistent winners apart is this. They have cultivated a specific mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse conditions.
Confident in spite of adverse conditions, that's key.
That's huge. As a direct result of this cultivated mindset, they are no longer susceptible to the common fears and trading errors that plague everyone else. Now, while nearly everyone who attempts to trade will eventually learn something about the mechanics of the markets, maybe some patterns, some indicators, very few ever truly internalize and embody these absolutely essential attitudes. Our analysis suggests that the path to developing this resilient mindset, for most traders, unfortunately, often involves a great deal of pain, both emotional and financial. A real trial by fire. Unless one was fortunate enough to be guided early on by someone who genuinely understood the true nature of trading, the psychological side, right from the very beginning. Most aren't that lucky.
All right, let's dig much deeper now into this specific trader's mindset. Let's uncover some of the inherent challenges and paradoxes that make it so incredibly difficult to cultivate, particularly this core issue of risk.
Yeah, risk is central.
The material we've explored highlights a fundamental paradox right at the very start. Trading, just by its very nature, is inherently risky. There's no way around it. There is no trade, not a single one, that has a guaranteed outcome. The possibility of being wrong, of the market moving against you, and consequently losing money. It's always, always present. It's just part of the activity.
It's baked in. And this inherent riskiness leads directly to a very common and, on the surface, perfectly reasonable assumption. People think, okay, if I engage in an activity that is inherently risky, like trading, then I must be a risk taker.
Seems logical.
It sounds entirely logical, doesn't it? And most traders, we find, not only make this assumption, but also take a certain amount of pride in thinking of themselves as risk takers. It becomes part of their identity, part of the self-perception. I'm bold, I take risks.
Right, the maverick trader image. But here's the stark truth, and it's a really powerful revelation from the source material. This assumption couldn't be further from the truth. While you certainly take a risk by placing a trade, you click the button, your money's on the line. That act alone doesn't automatically mean you are accepting that risk in its fullest psychological sense. There exists a huge psychological gap between merely taking a chance and truly accepting the non-guaranteed, probable nature of every single trade outcome, along with its potential financial and emotional consequences. The vast majority of traders, in fact, have absolutely no concept of what it means to be a risk taker in the way a successful trader thinks about risk. They fear the outcome, even as they initiate the trade.
So the distinction is profound then. The best traders, they don't just take the risk, they have also diligently learned to fully accept, maybe even embrace that risk. It's just a natural part of the process for them.
Like a cost of doing business.
Kind of, yeah. And this acceptance allows them to put on a trade without the slightest bit of hesitation or conflict. There's no internal struggle, no second guessing before they enter. And just as freely, just as easily, and without hesitation or internal conflict, they can admit it isn't working when the market signals they're wrong.
They can take the loss easily.
They can exit a trade even with a loss. And doing so doesn't cause them the slightest bit of emotional discomfort. It's just feedback. The inherent risks, the ever-present possibility of being wrong or losing money, they simply do not cause the best traders to lose their discipline, focus, or sense of confidence. It's just part of the game. Noise along the way.
Okay, so if you haven't reached that crucial point, if you find yourself unable to trade without emotional discomfort, maybe anxiety, fear, hope, even then you haven't truly learned to accept the inherent risks.
That's the indicator.
Right. And this inability creates a massive problem because, as the research highlights, to whatever degree you haven't accepted the risk is the same degree to which you will avoid the risk. You flinch.
You resist it. And attempting to avoid something that is, by definition, unavoidable in trading, well, that will have disastrous effects on your ability to trade successfully.
Yeah.
It's like trying to avoid gravity, right? It's a futile exercise that will inevitably lead to pain and mistakes. You'll hesitate when you should act. You'll jump the gun when you should wait, all in this unconscious effort to dodge the very thing you fear, the loss, being wrong.
And this ties into really deep universal human fears, doesn't it? Beyond the obvious, like fear of death or maybe public speaking. Losing money and being wrong both rank close to the top of the list of things humans find deeply uncomfortable. Admitting you're wrong, especially when it involves a financial loss, can be incredibly painful. It triggers feelings of inadequacy, maybe regret. And our natural inclination is just to avoid that pain at all costs.
It's perfectly natural psychologically. But while this is a completely natural tendency, it's also precisely what makes trading, which looks so deceptively simple on the surface, incredibly difficult to do well consistently. It presents us with this fundamental paradox. How do we possibly remain disciplined, focused, and confident in the face of constant uncertainty?
That's the million-dollar question.
It really is. The key, our analysis argues, is learning to think like a trader. And that means redefining your trading activities in a way that allows you to completely accept the risk. This profound risk acceptance is identified as a trading skill, the most important skill you can learn. Yet, astonishingly, it's rare that developing traders focus any attention or expend any effort to learn it.
They're too busy looking for the next magic indicator.
Exactly. They're focused externally on the market rather than internally on mastering their own response to risk.
Okay, so this crucial skill, risk acceptance, has a powerful transformative downstream effect, right?
Huge effect. When you truly master it, when you genuinely accept the inherent uncertainty without fear, the market will not be able to generate information that you define or interpret as painful.
It loses its power over you, emotionally.
Precisely. It transforms from a source of potential emotional anguish into just information, neutral data points. And this shift allows you to maintain an objective perspective, one that is not skewed or distorted by what you're afraid is going to happen or not happen. You're just processing data, not reacting emotionally.
That objectivity sounds crucial because it directly addresses the root cause of so many of those common self-inflicted trading errors, doesn't it?
Absolutely. Think about the recurring frustrations we all know. Getting into trades too soon, rushing in out of impatience or fear of missing out, or getting in too late after the move's already happened.
Or not taking losses.
Oh, the big one. Failing to take losses, letting them snowball into catastrophic ones. Or the opposite, getting out of winning trades way too early, just grabbing tiny profits out of fear.
Letting winners turn into losers.
Another classic. Or moving your stop-loss order further away, giving the trade more room, only to be stopped out right at the bottom before the market miraculously reverses back in your original direction.
Infuriating.
It's maddening. These are just a few of the many costly errors traders inflict upon themselves time and time again, caught in this cycle of frustration and blame.
And here's the critical point the research makes absolutely clear. These are not market-generated errors. The market itself is fundamentally neutral.
It just is.
It simply moves, generates information, presents opportunities. It doesn't control, it cannot control how we perceive or interpret that information, nor does it control our ultimate decisions and actions. These pervasive errors are strictly the result of what are called faulty trading attitudes and perspectives. These inherent, often unconscious attitudes are what foster fear instead of trust and confidence within the trader.
So the market isn't doing this to you, you're doing it to yourself, essentially, because of these underlying attitudes.
That's a tough pill to swallow for many.
It really is. The
Yeah.
distinction is put very simply yet profoundly in the source. The best traders aren't afraid. They have diligently developed attitudes that grant them incredible mental flexibility. This lets them flow effortlessly in and out of trades based purely on what the market is telling them about probabilities, not based on fear or hope. And crucially, they've also cultivated attitudes that prevent them from becoming reckless or overconfident after a string of wins.
So they avoid both extremes.
Right. Everyone else, to some discernible degree, is afraid. And paradoxically, when they're not afraid, maybe after a few wins, they often tend to become reckless. They take undue risks, maybe trade too large, deviate from their plan.
Which inevitably leads to negative experiences.
Exactly. And those negative experiences then, in turn, foster future fear, perpetuating this destructive fear-recklessness cycle. It's a vicious loop.
And this cycle is incredibly costly, debilitating. The research we looked at identifies that a staggering 95% of the trading errors, those mistakes that cause money to just evaporate before your eyes, ultimately stem from your attitudes about four specific things.
The core fears.
Yeah, they're called the four primary trading fears. And they are being wrong, losing money, missing out on a potential move, FOMO, and leaving money on the table, letting a winner run less than it could have. Think about how often those specific thoughts drive decisions during trading.
All the time for most people. And while it might seem logical, you might think, surely a trader should have a healthy fear of the markets, which sounds perfectly rational in everyday life.
Right, caution is good.
Sure. But when it comes to the specifics of trading execution, your fears will actually work against you in a very insidious way. They will, in fact, tend to cause the very thing you are afraid of to actually happen.
How does that work?
Well, if you're afraid of being wrong, that very fear will distort your perception of market information. It'll make you hypersensitive to anything that confirms your fear, causing you to make a decision or take an action, maybe exit too early, or hesitate too long that ultimately proves you wrong. When you're fearful, your mind literally narrows its focus. Physically, fear triggers that primitive freeze or run response. Mentally, it creates tunnel vision.
Blocking out other possibilities.
Exactly. It blocks out other possibilities, other interpretations of the data, rational thoughts, until the perceived fearful event has passed. You won't be able to access all the logical concepts you've learned about trading until that fear subsides, which often leads to that frustrating internal monologue later. I knew that. Why didn't I think of it then? Or why couldn't I act on it when it actually mattered? The fear hijacks your rational brain.
And it's extraordinarily difficult to recognize that the source of these persistent problems is our own deeply ingrained, often inappropriate attitudes. That's what makes fear so insidious in trading.
It really is. Many of the thinking patterns that adversely affect our trading are just a function of the natural ways we were brought up to think and see the world. The way our brains are wired to avoid pain and see pleasure.
They feel normal.
They feel completely normal. These patterns are so deeply ingrained in our subconscious that it rarely even occurs to us that our trading difficulties are fundamentally internal, stemming from our own state of mind. Instead, it feels much more natural, much easier to blame an external factor like the market itself. Because it feels like the market is directly causing our pain, our frustration, our deep dissatisfaction. We project our internal struggle outwards.
It's the market's fault, not mine.
That's the default setting for many. Now, these concepts, of course, they might seem abstract, maybe far removed from what most developing traders initially focus on, like finding the perfect entry signal.
Yeah, they want tactics.
Exactly. Yet, understanding and mastering the relationship between your beliefs, your attitudes, and how you perceive market information, it's as absolutely fundamental to consistent trading success as learning how to serve properly is to tennis, or how to swing a club effectively is to golf.
It's the core technique, but mental.
Precisely. To put it another way, understanding and controlling your perception of market information is essential, only to the extent that you actually want to achieve consistent, reliable results in your trading. If you're happy with random luck, maybe you don't need it. But for consistency, it's the silent, often invisible engine.
That's a crucial distinction because, and this is also profoundly true about trading, You don't necessarily have to know anything about yourself or even a great deal about the markets to put on a winning trade every now and then.
Luck happens.
Right. Just like you don't need to know the proper way to swing a tennis racket or a golf club to hit one good shot occasionally. Think about playing golf for the very first time. You might hit several surprisingly good shots, pure and clean, even without any formal technique. Feels great.
Beginner's luck.
Yeah. But your overall score, your consistency over 18 holes, will likely be terrible. To improve your overall score in golf, to achieve consistency, you need technique. Proper technique. And the same principle applies directly to trading. We need specific kind of technique to achieve consistent results. But what technique? If it's not just more market analysis.
That's the puzzle.
This is truly one of the most perplexing and frustrating aspects of learning how to trade effectively. If we don't grasp how our beliefs and attitudes profoundly affect our perception of market information, it will always seem as if the market's unpredictable behavior is the sole cause of our inconsistency. And then, quite logically, we'd conclude that the best way to avoid losses and finally become consistent is simply to learn more about the markets, endlessly chasing the next indicator, the next system, the next guru.
And this seemingly logical, yet ultimately flawed line of reasoning. That's precisely the trap that almost all traders fall into at some point in their journey. It makes perfect intuitive sense at first, if I just knew more.
Of course. More knowledge equals better results, usually.
Right. But the research we've reviewed unequivocally states this approach doesn't work for achieving trading consistency. The market, just by its very nature, simply offers too many often conflicting variables to consider. Think about the sheer volume of information hitting you constantly. News, data releases, expert opinions, social media chatter, conflicting signals from different indicators.
It's overwhelming.
Totally. Furthermore, there are absolutely no limits to the market's behavior. It can literally do anything at any moment. Every single person who trades, every new algorithm, every piece of unexpected news, every sudden shift in global sentiment, it's all a market variable, which means any individual trader or any unexpected event can cause virtually anything to happen at any time. Trying to analyze it all definitively beforehand is like trying to catch mist in your hands.
Impossible. So this means that no matter how much you learn about the market's behavior, no matter how brilliant an analyst you become,
Never enough.
you will never learn enough to anticipate every possible way that the market can make you wrong or cause you to lose money. It's just not possible. So if you're operating from that place of underlying fear, a fear of being wrong or fear of losing money, you will never learn enough to compensate for the negative effects these fears will have on your ability to be objective and your ability to act without hesitation.
The fear will always undermine the analysis.
Exactly. In other words, you simply won't be able to cultivate genuine confidence when faced with constant uncertainty, because the uncertainty will always feel threatening. The hard, cold reality of trading is that every single trade you enter has an uncertain outcome, period. And unless you learn to completely accept the possibility of an uncertain outcome without fear,
You'll fight it.
you will, either consciously or unconsciously, constantly try to avoid any possibility you define as painful. And that avoidance inevitably subjects you to that whole litany of costly self-generated errors we talked about. You'll sabotage yourself without even realizing why.
Now, let's be absolutely clear here. This isn't to say we don't need market analysis or a specific methodology to define and recognize opportunities. We absolutely do. You need an edge, a way to spot potential trades.
It's a necessary component.
Indispensable. However, market analysis alone is not the path to consistent results. It will not, by itself, solve the deeply rooted trading problems created by a lack of confidence, a lack of discipline, or improper focus. Those are internal issues. When you operate from that flawed assumption that more or better analysis will magically create consistency, you'll find yourself driven to gather this ever-increasing arsenal of market variables, indicators, tools.
Always looking for the next holy grail.
Exactly. But what's the inevitable outcome? You're still disappointed. You still feel betrayed by the markets time and again because of something you didn't see or give enough consideration to. You'll keep telling yourself, if only I had known that one more thing, then I would have been successful. It will feel like you can't trust the markets, like they're constantly tricking you or letting you down.
But the source material puts it bluntly.
Very bluntly, the reality is you can't trust yourself.
Ouch. That's the ultimate paradox, isn't it? The core of what's described as the black hole of analysis frustration. Confidence and fear are fundamentally contradictory states of mind. You can't really be both at the same time regarding the same thing, and both stem directly from our underlying beliefs and attitudes. To be Truly confident, deeply, unequivocally confident in an environment where you can easily lose more money than you intend to risk, that requires absolute self-trust.
Total self-trust.
It demands that you trust yourself to act rationally, to follow your plan, to cut losses decisively, maybe let winners run appropriately, to execute without hesitation or emotional interference. But you won't be able to achieve that profound level of self-trust until you have actively trained your mind, meticulously, to override those natural inclinations, fear, hope, greed, that are counterproductive to being a consistently successful trader.
And just learning more chart patterns isn't that training.
Right. Simply learning how to analyze the market's behavior, no matter how sophisticated that analysis becomes, is just not the appropriate training for that kind of internal mastery. It's the wrong tool for the job.
So you're left with two crucial choices, according to the insights we've gathered here. Two paths forward. You can either continue down that path of trying to eliminate risk by endlessly learning about as many market variables as humanly possible, which, as we've discussed, is that black hole of analysis frustration. It ultimately proves futile, it doesn't work for consistency.
The path of external focus.
Right. Or you can choose the path of profound personal transformation. Learn how to redefine your trading activities in such a way that you truly accept the risk and you're no longer afraid.
The path of internal mastery.
Exactly. It's a choice between external obsession and internal mastery.
And when you've achieved this profound state of mind, this deep acceptance of risk, what happens then?
The consequences are huge. You won't have the potential to define and interpret market information in painful ways. Think about that. The potential for pain is removed.
That's an incredibly powerful concept.
It is. When you systematically eliminate that potential for emotional pain, you also, by extension, eliminate the deeply ingrained human tendencies to, say, rationalize away bad trades. Oh, it'll come back. Or to hesitate on good ones. Is it really time yet? Or to jump the gun out of impatience or FOMO. Or to desperately hope that the market will either magically give you money or miraculously save you from your own inability to cut your losses when you should.
All those emotional interventions just fade away.
They cease to be a factor because the underlying fear that drives them has been addressed at the root. The market then becomes more like a canvas for executing your strategy, not an emotional battlefield.
And the irony of this mastery is really something, isn't it?
It's beautiful, yeah. As long as you remain susceptible to those kinds of errors, rationalizing, justifying, hesitating, hoping, jumping the gun, you simply will not be able to trust yourself. Not completely. And if you can't trust yourself to be objective and to consistently act in your own best interests, achieving consistent results will be next to impossible. Trying to do something that looks so simple from the outside, like clicking buy or sell, becomes the most exasperating thing you will ever attempt to do.
So frustrating.
Incredibly. Yet once you truly acquire the trader's mindset, once you can genuinely remain confident in the face of constant uncertainty, trading actually will be as easy and simple as you probably thought it was when you first started out.
Back when the dream first grabbed you.
Exactly. Back when the dream of unlimited potential first captured your imagination. It becomes effortless, or at least, but no less effortful. Not because the market suddenly changed or got easier, but because you changed. Your perception changed.
So what's the concrete solution then? How do you make that change?
It's precisely what this deep dive has been aiming to convey, really. The core task is this. You will need to learn how to adjust your attitudes and beliefs about trading in such a way that you can trade without the slightest bit of fear, but at the same time keep a framework in place that does not allow you to become reckless.
Finding that balance. Fearless, but not reckless.
Exactly. This isn't about becoming numb to risk or ignoring probabilities or being careless. It's about cultivating a precise, disciplined fearlessness, a state where you are completely present with the market, acting decisively based on your predefined plan without emotional interference clouding your judgment. It's about finding that sweet spot between paralyzing fear on one side and destructive recklessness on the other.
This journey, then, it really becomes less about what's out there in the market, the endless stream of data, news, charts, and profoundly more about what's in here within you. The insights we've explored emphasize that the successful trader you aspire to become is essentially a future projection of yourself that you have to grow into.
You have to become that person.
Right. This implies expansion, learning, and creating a new way of expressing yourself in the world, particularly in this high-stakes environment of trading. It's a profound internal shift, a personal evolution that goes far beyond merely acquiring more market information.
It's deep work. And that internal shift, it comes with its own unique challenges, doesn't it? Many of these new ways of thinking and expressing yourself, like accepting losses easily or not fearing uncertainty, will inevitably be in direct conflict with ideas and beliefs you presently hold about the nature of trading, and maybe even about yourself and your capabilities.
Your current programming fights back.
Absolutely. Your current beliefs, even if they're leading to frustration and unsatisfactory results right now, will naturally argue to keep things just the way they are. Your subconscious mind often resists change because it perceives the unknown as a threat, even if that change is ultimately for your benefit. It's an internal battle against ingrained patterns, a resistance to releasing what feels familiar, even if that familiar pattern is painful or unproductive.
But there's hope.
There is. The encouraging note here, and it's a powerful one from the source, is that your willingness to simply consider that other possibilities exist, possibilities that you may not be aware of or may not have given enough consideration to, will obviously make the learning process faster and easier. It's about opening your mind to a different way of being in the markets, a way that aligns your internal world with the external realities of probability and uncertainty. That openness, that willingness to question your current beliefs, is the first crucial step toward true transformation.
And that brings us towards the culmination of this deep dive today. We started by tracing the evolution of trading analysis, didn't we? From that initial, almost exclusive reliance on external fundamental factors.
What should happen?
Right. Through powerful insights offered by technical analysis with its focus on observable market patterns.
What is happening?
And finally, landing on the crucial, often overlooked internal landscape of the trader's own mind, the psychological dimension.
And we've explored how true trading mastery isn't ultimately found in chasing more complex models, or in perfecting your chart analysis skills until they're flawless, or finding that elusive secret indicator that never fails.
The Holy Grail myth.
Exactly.
Mm-hmm.
Instead, mastery lies in a profound psychological shift within yourself specifically, in how you relate to inherent risk, and how you manage and ultimately transcend fear. It's really about cultivating a very specific mindset, a unique set of attitudes that allows you to act with unwavering discipline and confidence, even and perhaps especially when faced with constant uncertainty.
So here's maybe a final provocative thought for you, the listener, to carry forward from our discussion today. The journey to consistent trading success is paradoxically, perhaps, less about outsmarting the market itself and much, much more about understanding and transforming yourself. What deep-seated beliefs, what natural human tendencies might be holding you back right now from the consistency and freedom you crave in your trading? And maybe more importantly, how ready are you to courageously challenge those internal barriers for true growth?
Because it's not just a market mission you're on. It is, at its very heart, a profound personal one.